On July the 15th, Elevance Health beat Wall Street's earnings estimate by $1.24. It raised full-year guidance. It raised its cash flow outlook. And the stock fell almost 9%, dragging the whole health insurance sector down with it. To understand why, you have to look at what 5 years of growth actually bought this company. Let's dig in. Start with the top line, because it is genuinely impressive. Elevance, the former Anthem, grew total revenue from $138.6 billion in 2021 to $199.1 billion in 2025. That is $60 billion of new revenue in 5 years, a 9.5% compound growth rate, built on 44.9 million medical members and the Blue Cross Blue Shield franchise in 14 states. Now here is the problem. Over those exact same 5 years, net income went down. $6.1 billion in 2021, $5.7 billion in 2025. GAAP earnings per share has been pinned near $25 for 5 straight years, and even that flat line is flattering, because roughly $2.6 billion a year of buybacks shrank the share count, while the profit dollars shrank too. $60 billion of new revenue bought zero profit growth. The culprit has a name, the benefit-expense ratio. In the second quarter, it hit 89.7%, up 80 basis points year over year. That means nearly 90 cents of every premium dollar went right back out the door as medical costs, driven by elevated trend in Medicaid and Medicare, behavioral health, specialty pharmacy, outpatient surgery, emergency rooms. That is where the $60 billion went. That ratio crushed the quarter under the headline beat. Operating revenue rose less than 1% to $49.8 billion. Total operating gain fell 27%. The core health benefits segment saw its margin nearly halved, from 3.8% to 2.1%. And that adjusted earnings beat of $7.45 came with an 80-cent below-the-line benefit from investment gains, which management plans to spend on one-time investments rather than bank. The market saw through it in about a minute. The pressure point is Medicaid. Elevance runs roughly $57 billion of annual Medicaid revenue at a negative operating margin, guided to about negative 1.75% this year. Management called 2026 the trough year, and they are backing it with action. July rate updates from states came in at the upper end of mid-single digits, better than planned. They are exiting the DC Medicaid market, with more exits coming over the next 12 to 18 months, where the math does not work. While the insurance engine compresses, the services engine grows. Carelon posted $19.2 billion of quarterly revenue, up 6%. Carelon RX, the pharmacy business, grew 5.7%. Carelon Services grew 7.2%. This is the structural answer to the margin squeeze, revenue that does not carry a 90% benefit ratio. It is not big enough to carry the company yet, but it is the fastest growing thing Elevance owns. One genuine risk got removed this quarter. In February, the Centers for Medicare and Medicaid Services flagged historical Medicare Advantage risk adjustment data going back to 2015. Elevance accrued $935 million, $4.27 a share, and paid an initial $342 million. Then, on July 13th, regulators confirmed in writing, all steps completed, no sanctions, matter closed. A threat to the Medicare franchise was settled in 5 months for a known number. Cash flow tells the harshest version of the 5-year story, and may be the first sign of the turn. Annual operating cash flow fell from $8.4 billion in 2022 to $4.3 billion in 2025, cut nearly in half while revenue grew. But first half 2026 cash flow doubled year over year to $6.2 billion, and management raised full-year guidance to at least $6 billion. If the trough thesis is real, this is the line where you will see it first. So, what is it worth? At roughly $379, Elevance trades at 14 times this year's raised guidance of at least $27, and about 13 times the $29 implied by management's 2027 framework. A 10-year discounted cash flow gives a bear case near $265 if Medicaid rates never catch up, a base case near $505 if the trough holds, and a bull case near $590. Today's price is pricing the skeptical case. To be clear, that is implied value under stated assumptions, not a price target, and none of this is investment advice. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. Here is the watch list, the benefit-expense ratio against that 89.7% mark. Medicaid rate updates this fall. Medicare Advantage holding its 2% margin. Carelon compounding faster than the enterprise. And whether the promise of at least 12% earnings growth in 2027 survives, Elevance proved it can grow revenue. 2026 is the year it has to prove the profits can follow. If this breakdown was useful, subscribe for more filing-driven deep dives. Thanks for watching.